Hello and welcome to ICICI Prudential Mutual Fund and CNBC TV18.com presents Smart Investor, an exclusive e-forum with leading voices from the industry sharing their insights to help you navigate through the investment world and bridging the gap between savings and investments and creating long-term wealth for investors through a range of simple and relevant investment solutions. I'm Sumaira Abidi and I have with me Pankaj Mathpal, founder and managing director at Optima Money Managers. Hi, Pankaj. I'm going to get
Hi,
to you.
Sumaira.
Before that, let me just remind our audience who are watching this that please post your comments and questions on the Facebook page, and we'll take some of those questions a little later with Pankaj. Okay, so Pankaj, the first thing that people want to talk about, or they've been asking of late, is that how do I change my strategy now that there's so much volatility? But what I want to ask is that is there a strategy that can really be tailor-made for volatile situations, or is there just a strategy that you have to sort of stick through thick and thin?
See, Sumaira, when you invest in mutual fund, you already know that in long term, there will be markets ups and so this is a different situation at this time. But still, I'll say that in market, in past also, we have seen this kind of situations. So bear market, bull market, ups and downs. This is the nature of equity market. So diversification, asset allocation, and investing in staggered manner, these all things we follow. So this time also I'll say that you should stick to your goals. If you have already decided your goals, you're investing according to that. So and if you were investing before without deciding your goals, just means not keeping anything in mind. So this is the right time that you should set your financial goals. You should see whether you have a proper asset allocation or no. And those changes may be required in your portfolio, but not like because market is volatile. So I've seen that many investors, they start redeeming their funds, they start stopping SIPs. So that is incorrect. So if you are investing based on your financial goals, then stay invested. Otherwise, the right time that again you just check your portfolio, review your portfolio, and align those investment to your financial goals.
Yeah, that's true. So let's, for the sake of argument, split these investors into two buckets, right? One who has done their goal setting and their planning and are investing according to a strategy, and the other set who has not yet made their financial plan or their goals, and therefore they have just invested on a as-is basis, or perhaps even new investors who are yet to begin investing. How do volatile times treat these three categories of investors? I mean, for somebody who has made their plan, there are challenging environment right now. Some people are losing jobs. There are pay cuts. How can they adjust that to the reality? For somebody who has just invested in an ad hoc manner, how do they streamline their investments? And for somebody who's just getting started, is this period of volatility the best time to actually introduce a financial plan?
So Myra, see in all these situations, first thing, where investors have set their goal and based on goals they were investing. The only challenge because of this layoff and salary cut, investors may be facing problem. I understand. So they can take a pause for some time. Definitely good time will come and then they can restart their investment, increase their SIPs. Those choices are available. So for those investors who are temporarily facing some problem, for them only this situation that they should stop their investment for some time that they can do. But otherwise, if only the problem is that markets are volatile and they are scared, I'll say that they should stay invested for long term. And then in that case, definitely they will earn returns from their investment and achieve their financial goals. Second thing, where you said that investors who invested without any planning, for them, my suggestion, because I always say that first set your goal and then invest. But sometimes it happens that people started investing based on some tips or started an SIP mutual fund without keeping any goal in their mind. in such case, this is the time they should see if they are long-term investor, then their investment should be in equity for long-term because to beat inflation, they must invest in such asset which can beat inflation and generate returns. If they are for small term, then definitely they should see whether the investment is in what kind of asset class, because in short term equity will be more volatile and it's not right to have allocation equity for a very short term. So they have to see that they should now set their goals and align their investment with their goals. And third thing, investors who are now starting, for them, I will say first thing they should write their household budget. They should see their cash flow because at this moment, first and foremost thing is having appropriate liquidity. So contingency planning is very important because still we don't know how long the situation will last. So having proper cash flow, having proper liquidity, that is more important. So based on your cash flow, based on your household budget, then you see that how much surplus you have to invest. And then again, coming back to the setting your goals and then investing accordingly. So that will come in picture. So for new investor, my first suggestion will be that don't take any decision, impromptu decision or something like that because you have money and you're investing. But see that the situation is little different. It may last longer. So have the proper planning for your liquidity and cash flow. Then set your goals, and based on that, you start investing.
All right. The other thing, Pankaj, that I wanted to ask you to explain to our audience is that, a lot of people expected that because, we were hit by this pandemic, the market would sort of head south. But we've seen that, while the economic outlook is not very bright, the market, which is flush with liquidity, is just heading higher. And a lot of people who are waiting on the sidelines, perhaps for corrections to increase their SIPs or, make lump sum investments, have sort of missed out. So how does an investor understand this dichotomy between, all the cues they are hearing about global growth, Indian growth, pandemic situation, companies having a challenging time, and yet the market continues, rising. Should they continue their strategy even in such a time?
Sumaira, that that P of the market is around 30 or has crossed 30 rather, I'll say. So definitely, according to me, markets are expensive. There can be some stocks which are available at very good valuation, but overall market, if I see, I see that it is expensive. So investors who have not invested in equity market, if they're starting now, they should invest in staggered manner through SIP, STP route, or they make their own strategy whenever market comes down, they invest. But investors who feel that they have missed the bus and they should invest now in lump sum, it will be risky for them. So investing in a staggered manner will be the right choice because market is up. Say some investors, they may argue on this also that if we see the peak of the Sensex, so still we are close to that, but they're not reached there. But as you said that earnings of the company, there's a difference in that. So considering those facts, markets are expensive. So I'll say that you invest in a very professional manner. Instead of investing in direct equity, take the help of mutual funds. So they're at least professional fund managers. They're managing your portfolios. So portfolio of the scheme. So invest in mutual funds, invest in a staggered manner in mutual fund also. Have a diversified portfolio. Do not go for a particular thematic or sectoral fund or on a particular market capitalization. So have a multi-cap fund and diversified equity fund where you invest in diversified sectors, all the sectors together. So that should be strategy. And at this point of time, even the existing investors also, if they are thinking to invest more because markets are going up and up every day, I'll say that they may get tapped. So staggered manner, if they are doing SIPs, continue to SIP only. Do not invest in lump sum right now. And that will be my advice.
Okay, but the clear, takeaway for an investor should be that, stay invested and carry on the path that you have pre-decided whether you were hit by volatility or not. And you may make some alterations or changes as required, but important to stay invested. In fact, Pankaj, you'd be interested to know, I was reading some very interesting research the other day, and it said that, over the last 10 years, if you look at the Sensex performance, all the gains can be attributed only to about 8 months, right? So that's just 7% of the time that somebody could have stayed invested over the last 10 years to make up for all the gains. And, if you hadn't been a regular investor, you could have missed out on this rally. And then, how do you know when the next 8 months will come? So periods of great, corrections are followed by, steep recoveries. You cannot time the market. And that, I guess, Pankaj, would be the most important lesson for investors, right? That even in times of volatility, stick it out, ride it out, the trough, the high, it will not even out later.
I agree, Sumaira. This is what happens. Investors, they invest for long term and then somehow they're not making returns. So they exit from the market and then they realize that they missed something. So you cannot time the market. Only thing that you should stay invested for long term. There will be times where for 4 years, 5 years, even you don't make money in equity market. But there will be time when in next few months only returns will be so high that average will be quite good. That is why only we always talk about the CAGR. We are not talking about the absolute returns that year on year basis. It's not fixed deposit. When you invest in equity shares or equity mutual funds or any mutual fund for that matter, you cannot compare that with fixed deposit where you get guaranteed returns. Here, 2 years you will not get returns, but it may happen that in 1 year only returns are so high that your average of those 5 years, average of those 10 years will be quite good. So that is why I always say that if you cannot time the market, stay invested for long term. And yes, there can be some strategies like when markets come down, you can increase your SIP amount, you can top up your SIPs, step up methods. So those all things can be done, or pausing SIP, that is specifically when you have liquidity problem. Otherwise, I'll not say that to try to time the market, because whenever you try to time the market, later it happens that you realize you did a mistake. So not for that reason. But whenever market comes down, you should double your SIP, increase your SIP. So that should be done. But whatever amount you have decided, at least continue with that. Then on top of that, you can add some more amount. So that is what I have seen. Means most of time that investors, they don't make money only for one reason, that they invest for long term. But after some time, like when they realize that the returns are not coming, they exit, and then the time when they see that markets have started performing.
That's true, actually. And, it's only once the news is out that investors fear for their investments and take money out. And by then they're already making a loss there. And, to get back in at lower levels somehow never happens. And so we miss the bus altogether. But Pankaj, the other thing is that a lot of people commit to making an investment, right? So suppose somebody meets a financial advisor and they say, what, based on your salary expectations, an X percentage can be invested, and the investor commits to it. But, oftentimes that's not sustainable. How do you suggest or recommend that an investor know that what is the level of sustainable investment that they can make?
If you write your household budget, many things are clear. You understand that how much you need for your regular expenses. And when you write your budget, then you also know that there could be some expenses which can be cut. So try to make your budget, household budget, and follow it. Then based on that, definitely your financial goals also, you have to treat them as your expenses only. Means you are investing for your financial goals. So based on that, usually we say that like 30-40% you must save for your future financial goals, but it depends on each individual. But in any case, it is important that you should treat your financial goals as your expenses. So you should invest for them. Now, once you know that you are comfortable saving a particular percentage of your earnings, your income, then you, based on that, make your goal. Because one thing is there, if you think that your goals are not realistic, if you are very optimistic and somehow you are trying to save as much as possible, but then you may not be able to continue with that. So that also you have to keep in mind that your goal should be realistic and you should see your income and expenses. Then based on those realistic goals, you should plan to invest. And still, if sometime such situation comes that you are not able to manage that, then you always have choice to reduce your investment for the time being. And when the good time comes, then again you can increase your investment. So based on your financial goals, if you do planning, it will be more helpful for you. But again, according to the situation, you may make some changes in your financial plan. And that is why we always say that keep reviewing your financial plan and rebalancing of the portfolio. Those things are required in the financial planning.
Right. I take your point that basically don't abandon your plan altogether. Stick to it. You may want to be accommodative of the environment or the challenges that are being presented. But Pankaj, now let's get a little bit more specific. If somebody has a portfolio that they have made a mutual fund portfolio based on their strategy, etc. What a lot of people, the most common mistake that I see is that there's a lot, they say we have diversified, right? What do you mean by diversification is that whether it's across AMCs or, different fund managers, different styles, but a lot of them have a lot of overlap. Right? So the entire portfolio either performs or it doesn't. There isn't any sort of balance that, in this market cycle, this portion of your portfolio will perform. In another market cycle, the other part of your portfolio will perform, right? So that you're never like really badly off. So how does that blend, or how do they, strive to achieve that balance? Is there any rule of thumb about which is the optimum way of selecting mutual funds that sort of go well together and support each other through various market cycles?
Sumaira, there should be negative correlation between the asset classes and between the securities. Then only you can achieve this. Because if there is positive correlation between two schemes, two securities, then whatever the market does, you'll get the same return in all the investments. So best thing is that there should be negative correlation. But in common, if I say, people should have investment in different asset classes and different kind of schemes. For example, if you're investing only in large cap and large caps are not performing, small caps, mid caps are there outperforming the large cap, then definitely you will lose the opportunity. You will miss the opportunity. So in such case, if you have investment across the market capitalization, you have some large caps, some mid caps, some small cap in your portfolio, so you will get better returns. Second thing, like we have seen in last 1 year, healthcare sector, pharma sector, and international mutual funds have outperformed the other kind of sectors or Indian stock market. Now people realize, investors, they realize that they have missed this opportunity because they do not have exposure in international funds. And in last 1 year, we see international funds have delivered much better return compared to domestic funds. So my suggestion that everybody should have exposure in different kind of schemes. When one thing is that in domestic funds also we should have across the sectors, across the market capitalization. You must have some exposure in mid cap, some in small cap, large cap, and also in international funds. And when I talk about thematic or sector specific, that one thing, if you have diversified fund, then you will have any sector in your portfolio. But if still you have good knowledge about the market and you feel that this particular sector will outperform the overall market in a particular time, but you should know when to enter and when to exit, because a sector cannot outperform an overall market always. So considering that, what you should do, if you feel that during the particular time this pharma sector will do better than the overall market or a financial sector will do, so during that period you can have some more exposure or higher exposure in funds of that particular sector. I'm not saying that buying stocks, but sectoral mutual funds you can have in your portfolio for that time so that you can get better returns. So that is also one thing investors should keep in their mind, but that is only possible when investor has knowledge about the particular sector. Otherwise, diversification across the sectors, across the market capitalization, and in international as well as domestic funds.
Yeah, but Pankaj, what happens is like if me as a retail investor feel that the pharma sector is going great guns and I increase my exposure to pharma, well, guess what? So is my large cap fund manager, right? But so that's something that investors should also think about. But Pankaj, the other thing is, since we're talking about this balance in the portfolio, how does one decide the balance between equity and debt, and what sort of harmony does that require in a person's portfolio?
Yes, Sumaira, see, based on your objective of investment, risk appetite, and time horizon, these three things are uh, most important parameter to decide your asset allocation. So, if you are investing for a long-term goal, say 15 year, 20 year for retirement, especially, in such case, you must have higher allocation equity. See, whatever means your risk appetite is moderate or high, but in any case, you must have higher exposure in equity. Why? Because in long term, you have to beat inflation. Otherwise, when you are 60 years old, that time you will realize that you do not have required wealth. And then you cannot go back. So that is why when you are young, you must take some risk. And when we say risk in equity, it is basically a volatility. It does not mean that in long term you will lose your whole money if you're investing through mutual funds or with the help of professionals. You will not lose your money if you stay invested for long term. So that is why you must have higher allocation equity when you are investing for long term. But at the same time, when you invest for short term, equity is very volatile. You should have very small exposure, or you invest in other asset class like gold or debt for that time period. Now, second thing is your objective of investment. See, if somebody asks me that he wants to invest for 5 years investment time horizon, now there can be two different objectives. One is that after 5 years, he says that my child is going for a higher education abroad and I need money exactly after 5 years. And second choice can be where investor says after 5 years, I want to go on a vacation. So definitely when you want to go on a vacation, you can take higher risk. But when you say that you need money after 5 years exactly, and you cannot postpone that goal, in such case, you should take a little risk, lesser risk. So your asset allocation will depend on both the things. One is that objective of investment, and second, as I said, time horizon. So based on that, you should have, but at any point of time, you must have some exposure in equity only when you're investing only for 1 or 2 years, a different thing. But if you're investing for 3 years, 5 years, 10 years, or longer than that, you must have exposure in equity because many times investors say that there's a risk, but I'll say not investing in equity may be higher risk because you'll not be able to beat inflation if you do not take help of equity. Historically, we have always seen that.
Yeah, that little extra, right? What we call the alpha. Okay, Pankaj, the other question that a lot of investors get confused about, and especially when the market, is seeing a lot of ups and downs, is what should be the periodicity of their SIP? The investor says, okay, fine, I take your advice, I'm going to stay invested, but should I be doing my SIP just at once a month? I mean, markets are so volatile and things are changing by the hour. Shouldn't I increase the frequency of, how maybe reduce the amount, but increase the frequency of the SIP? Is that a good idea?
Yes, yes, definitely, it's a very good idea. And I have seen most of the time investors what they do if they are investing in four SIPs, all the four SIPs have the same date. Now then they complain about this that whenever I invest, that time market is up, and after that market comes down. So if you feel like this, though the purpose of SIP is to achieve rupee cost averaging in long term and more the means I mean staggered manner you are investing, there will be more rupee cost averaging. So if you're investing 4 times in a month, that will be better than investing once in a month. So if you're investing in one SIP also and it is 5,000 rupees, you divide it in four parts, so weekly SIP. Or if you're investing in four different SIPs in four different schemes, in that case also you can make it like that one scheme every week like this. But if there are higher frequencies than monthly, then you will achieve this rupee cost averaging better.
That's an interesting concept, and Pankaj, as always, I have learned something new from talking to you. So we have also some queries that have come in from our audience. So let me just read out some of them. The first query is from Ashish Sinha. He's written to us from Delhi, and he wants to know if one can invest in multiple asset classes using one mutual fund scheme. So, it looks like this is the season for that scheme, isn't it, Pankaj?
Yes. So, Mera, one is that he asked the question at the right time when we are seeing that gold has outperformed equity in last 1 year and some volatility in equity. So, if you are investing a small amount and you cannot diversify your portfolio, like you cannot have more than one scheme in your portfolio, you have choice to invest in a multi-asset fund. So, we have multi-asset funds as well. There are funds, there are schemes where you can invest in equity, debt, international stocks, as well as gold in one single fund. So there will be hybrid scheme which invest only in equity and debt. There are schemes which invest in equity, debt, and gold. And now there are schemes even which invest in equity, debt, gold, and along with that, they also have exposure in international equity, international stocks. So if you're investing with a small amount, you can start investing in a multi-asset.
Okay, Pankaj Kumar from Kolkata asks the next question, and this is again very interesting. He wants to know, how do I switch from one fund to the fund of another company, another AMC? Ouch, that's going to hurt. But Pankaj, practically, what's the advice?
No, see, if you want to switch between the scheme of same AMC, then it is possible that you can do intra-switch. But then if you want to switch from one AMC to another AMC, you have to redeem your scheme and then redemption proceeds you have to reinvest.
Okay, and basically you have to also take care then of your taxation requirements, and depending on when
Exit
you're
load as well.
Exit load as well in some cases. Yes, and Pankaj, this may be a good opportunity for you to actually explain to people how taxation on SIPs work, because it's not always when you start the investment, it's also about every single SIP thereafter, right?
Yes, yes. So, Mera, in SIP or STP, whenever you invest, so SIP, because you are investing every fresh SIP is a fresh purchase. So, if we say long term or short term, so in equity, for example, if we say long term after 1 year, does not mean 1 year from the date of initiation, date of starting of SIP. For each installment, when you complete 1 year, that will be considered as long term. So suppose you are investing for 12 months and after 12 months you stop totally. So after 11th, after 13th month, after completion of 12 months, if you redeem, so only the first installment will complete 1 year. So if you want that complete investment of 1 year should get the status of long term, you will have to wait for 2 years because last installment will complete after 1 year from there. So that is why you should keep in mind, and that is applicable for exit load as well wherever. Exit load is applicable. If the scheme says exit load applicable for 1 year, it means each installment should complete 1 year, or otherwise you'll have to redeem in parts. So whichever amount, whichever installment has completed 1 year, you can exit that, which you will not do, but that is the choice. So that is why you should always keep in mind. And in non-equity scheme, whether it's a debt, liquid, or fund of funds or gold, here we know that holding period less than 3 years is short term, more than 3 years is long term. So you have to keep in mind. And in ELSS also, sometimes that when investor they invest in tax saving schemes, I mean ELSS schemes, there also they invest in for lock is 3 years. But you can invest in lump sum, you can start SIPs, but there is a lock-in of 3 years. So sometime investor they get confused that they will invest every month for 3 years, and after 3 years they'll be able to redeem the whole amount. But that is not possible because in SIP, each SIP installment is considered as a fresh investment. So in that case also you have to see that after 3 years you will not be able to redeem the whole investment. Only installment which completes 1 year that you can redeem. So you have to keep in mind for the taxation, for exit load, for the ELSS lock-in, whenever you invest, always keep in mind that SIP means fresh investment every time when you invest. One more point I want to add regarding STP as well. In STP, systematic transfer plan, you switch from one scheme to another scheme. So that is also considered like redeeming from one scheme and buying another scheme. So in that case also you have to see this taxation and exit load wherever means applicable, because you are redeeming one scheme and then switching to another scheme.
Okay, so Pankaj, your namesake has given a very, very elaborate answer. There are many things to consider when you want to shift from, one AMC to another, and you have to see, your opportunity cost, whether you're going to make more over there, you're going to lose more in terms of taxation, exit load, etc. So keep all those points in mind. Sudhaka from Baroda wants to know what happens when the market falls midway while you have invested for a longer term. Well, Sudhaka, before Pankaj answers, I'm going to tell you, if you've invested for the longer term, well, then why are you worried about the midpoint? Well, Pankaj, what would you say?
Definitely, if you are investing for long term, stay invested, and it's an opportunity for you. If mid term you see that market has corrected, if possible, increase your investment. Invest in lump sum a little more amount in that. So that will give you higher returns. So that is what you can do, but don't worry about the volatility. That is the nature of market. If your goal is long term, believe me, because historically also we have seen many times that market corrected and then it bounced back. So similar to that, it will happen this time also. Stay invested. Whenever market comes down, and if it is possible for you to increase your investment for a period of time, you can do that.
Okay, well, Sudhaka, the only thing is if you invested for the long term, the biggest challenge is remember that you have invested for the long term. Up next, Vikas Tiwari from Patna wants to know, are there any particular funds that help create wealth over the long term? Well, Vikas, I guess take your pick, right, Pankaj?
Yeah, see, long term means you in equity schemes will only outperform other schemes, that I believe, because if you say really long term, say maybe that not 5 years even that, but 10 years, 15 years for long term goal when you're planning, then historically we have seen that equity as an asset class has this power that or scope of generating better returns compared to any asset class. So stay invested, invest in good schemes, and keep reviewing your portfolio. See, I cannot say that if you start with one scheme and it was performing that time, because usually investors, they invest based on the past performance. But there is no guarantee that the scheme which performed well in the past will only perform better in the future as well. So considering that fact, you should always review your portfolio time to time. And if required, if maybe because of changes in the style, change of fund manager, there may be many different situations. So you should always review your portfolio, review the scheme's performance. And if for long term, the scheme is not able to beat the benchmark, not able to beat the returns of its peers, in such case, definitely you have choice to take your decision to switch to another better performing schemes, but don't do it quite often.
Yeah. In fact, there's any number of data now which suggests that, the best performance of the previous years are not necessarily the best performers of the coming years. That, there is this whole cycle that takes place. But like Pankaj said, don't take that decision lightly. It is an important decision that must be taken with great care. And Pankaj, perhaps the most important question of today comes in from Rai Kalyan from Pune. And he asked the question that I wish more and more investors would ask, which is, how do I review my risk profile?
See, your risk profile, nobody knows better than you yourself. So there are two things. One is that people do not have knowledge about something, and that is why they feel that there's a risk. And second thing, definitely they have some, based on their situation, their lifestyle or family conditions, there may be things that they cannot take risk. So one thing that you understand the asset class, if I talk about investment, and then think that still there's a risk or no, because sometimes people do not know equity. They have heard this thing that in equity people lose money. And this is a fact also. Many investors, because of lack of knowledge, they invest directly in the stock market based on the tips given by friends and relatives, or even for that sake, uh, fund sorry, their broker, without considering their risk profile, and people lose capital. So they have this in their mind that in equity market people lose money, but they don't know that out of those stocks which are listed in the stock market, there are some good selected stocks which will give good returns in long term. There cannot be a zero uh, value of those stocks. So if investors, they understand the equity market, mutual funds well, and then they realize that still considering these all facts, they cannot take risk of volatility because there's a different situation. Uh, if I give example, if person says that my job is not very secured, I may lose job, my income is not I do not have a human cash flow. In such case, there may be a different case. But if somebody is saying, no, everybody's right, I get salary fixed, I have the secure job, but still I have heard that equity markets, there's a risk. So that is why I do not want to invest in that. So my suggestion that you know your situation, but for long-term goal, understand the equity and invest in that. Do not invest in direct stocks if you do not understand it well, but in good mutual fund schemes, you should invest for long term, because if you do not invest in equity mutual fund today and with the 6-7% return, see, everybody will say that guaranteed returns are something I like, but when you see fixed returns of some fixed deposit or something, then you see the inflation, then you realize that if you do not invest in some asset class or instrument which gives you returns higher than inflation, then you will not be able to achieve your goals. Ask the people who have somebody who is sick, they need money for that, but do not have that. What is the situation? So for those things or for the other financial goals, everybody has to plan in advance. You cannot plan when the situation occurs. So that is why you always see, understand those different asset classes and invest in that.
All right. Well, the clear understanding from this entire chat with Pankaj Mathpal seems to be one, of course, is assess your risk profile, make a plan, an objective, where you want to invest, how you want to do it, and stick to it. Don't get worried about the short-term volatility. If you're a retail investor, if you want to create wealth, you have to stay invested for the long time. And above all, you need to invest in the vehicles which will actually help you generate wealth over the long term. One of them, of course, being equity mutual funds. Pankaj, thank you very much once again for your time this afternoon and for taking this time to actually explain to our retail audience about the best way to invest when times are volatile. Well, thanks once again, Pankaj. And for all our people who are watching, I want to remind you that there's an Independence Day special webinar also coming up on the 14th of August on the topic of being finally self-dependent. Thank you very much for watching. I hope this has been helpful for you and you enjoyed this. Thanks very much once again.